All right. What's going on, everybody? Christopher Inks with TexasWest Capital. Got my co-host here, Andrew Parrish, Tillman Holloway, and our wonderful guest here, living the life. I mean, see, this is what happens. Listen, guys, if you're making money in the markets over decades, you can be traveling above the planet in your own little Star Trek thing. And he doesn't even have a crew, man. His crew is AI. I'm telling you, this is Dave, man. Good to have you here, Dave.
Whoops, I'm muted. Oh, no, I'm not muted. You guys can hear me, right?
Beam me up, Scotty.
Hey, yeah, beam me up, baby. Yeah, it's only but a goodie. You know, in the world of Star Trek, remember, they didn't have physical pieces of paper. They didn't have capitalism. Only in Deep Space Nine did you hear something about gold press latinum. But basically, everything in Star Trek was credits, which presumably, if you think about it, it's almost certainly blockchain technology. Probably,
yeah, that was tokenization. Tokenization.
Everything was simple and clean.
Well,
banks didn't exist in that world.
That's a perfect opportunity to educate people on what a UTXO is. That's a credit-based system. That's all it is. So yeah, I couldn't agree more.
So I thought it was appropriate for my first time on Bitcoin with my very tiny little beard here.
Honorary beard. We'll call you honorary beard here. You also have more hair than us on top, though. It's like it's flipped. So
that's genetics. I'm lucky that way. My mom's father had at least half a head of hair at 92 when he died. So
wow.
So hopefully I'll get to keep it. And my mom didn't go gray or wasn't fully gray in her late 60s. So I'll be 64, believe it or not, at the end of this month.
Really?
Again, a truly thrilling start to the podcast.
Yeah, well, hey, gotta get the crap out of the way, Andrew.
Hey, listen, guys. So, hey, great week with Bitcoin coming up here. Obviously, all the doomsdayers out there are doubling down. This is what they do.
Good.
We've had a nice bounce off that 80,000 area. We hit almost 94 today. And amidst all of that, ETF flows, Bitcoin flows are stabilizing now, which, as anybody knows, when you're starting to get to the when your asset class gets into the hands of the of Wall Street, you start watching those ETF flows, right? And that's especially relevant here with Bitcoin. So we've got that coming in. We've got that today or yesterday or whatever it was. Vanguard coming out and saying, okay, I give Uncle. You can trade crypto ETFs on our platform now. It's a $9 trillion platform they've got going on. So a lot of good stuff coming here. What are you guys thinking about all that?
Well, I'll start the show with what I usually get to the show, which is don't fade the fink. The guy will not stop talking about crypto. They'll not stop talking about the fact that their Bitcoin product is their most profitable product, and that's what they make the most money off of inside of BlackRock, which is incredible to discuss, given that they're a nearly $12 trillion asset manager.
And it's only been 2 years.
Yeah, and then on top of that, Larry comes out and says the tokenization movement is effectively like getting into the internet in 1996. Seriously, I don't know the level to which they are leaning into crypto is unprecedented. It's almost as if they're more bullish and more pound the table, right? So Dave and I were in the world of traditional finance long ago when pound the table was quite the statement, right? Pound the table on a particular position, and they're double fisted hammering the table associated with crypto. It's extraordinary to watch. This is so rare to see them take this type of position. They must assume that crypto and tokenization, or the one and the same to some degree, are going to turn them into a $25 trillion asset manager at some point. That's the only It's the only way I can see why they're doing this. It really is extraordinary to see what's coming out of BlackRock associated with crypto. To be somehow bearish, the only way you can be bearish is if your time frame is like 7 hours or something. Because you can't look at that and say, well, I don't know, but maybe this crypto thing's gonna fade. It's just extraordinary.
Well, I mean, look, I don't like to use the word crypto in that sentence because I think there's a lot of crypto that is eminently fadeable.
Mm-hmm.
I think in the long term, I think in the short term, it's eminently tradable. And I think there are some clear winners. So if you ask me, crystal ball, I absolutely hate putting timeframes on it. But let's just say in the medium term, 2 to 5 years, I would say that in the top 25 to 100 coins, the total market cap of what will be in coin market cap will be dramatically higher than it is today. I think 3 to 5x probably is where I would come in on the top 50 coins. I think Bitcoin will be leading that, but not alone in that. That said, I think there are quite a few of the top coins that are tapped out, that have no value proposition or have overinflated value propositions, and I think there'll be new ones that will come in. But the truth is that there is a market here. There's two different things going on. There is a steam engine, a train, not just a train, as Lynn Alden calls it. We're talking about like the Ouroboros of monetary policy. Ouroboros is that famous snake that eats its own tail. The fiat system is eating its own tail. Now, it still encircles the world today, but the need for more debt, more printing is accelerating. Now, is that going to blow up in the next 5 to 10 years? Frankly, I hope the hell not. I don't want a Mad Max scenario. But the truth is, as it continues, assets that have monetary value, like gold and Bitcoin, will continue to thrive. Bitcoin is a critical mass item. People ask me all the time, why am I standing here feeling like Gandalf, only in this particular case, when I set it at 100, the Balrog got past me. But the truth is, I'm sitting here saying, this market is going higher, and it's because of a very simple stat. It may be the easiest stat to understand too, and that is price divided by hash rate. And when you do that, we are at the all-time lows, or we hit the all-time lows last week. We're still well below the market. And when you look at that, and I showed the chart on Scott's show with Noel this morning, we are at an obvious buying opportunity. Now, the buying opportunity might stay, and it might even get cheaper over the next few months. It might, but in the near term, it is going to start to correct, and we will get back to some level of parity, and we probably will go above it. When we go above it, that euphoria stage is when you probably want to sell, not because Bitcoin is at its all-time high, but because it's going to correct. We saw this in 17. We saw this in 21. We're going to see it, I think, in 26, maybe 27. It's just the way things go. Doesn't mean it's not going there. What BlackRock is saying, what Fink is saying is, listen, his view of the monetary value of gold is roughly the same as mine. And he thinks Bitcoin could get to pari passu with gold. Not take it from gold, but get to equal status with gold. Equal status with gold is $500,000 to $700,000. Taking away from gold is $1 to $1.4 million.
To jump in, because this is a prescient in the moment point. So one of the most famous little get-togethers in TradFi is the New York Times Deal Book Summit with Andrew Ross Sorkin. Right now, Andrew Ross Sorkin is on stage interviewing Larry Fink at DealBook. Who is sitting right next to Larry Fink at the DealBook Summit? Brian Armstrong of Coinbase. I mean, I don't know what other thesis you need associated with crypto.
Well, it's just one angle. I mean, there's the thesis, I think, can be explored and viewed from multiple angles. And I think that they all say the same thing, which is equally exciting. Like Larry Fink, to me, is obviously, I don't know what he believes about Bitcoin. I really don't care. I see Larry Fink as the guy in Pinocchio who has the amusement park for the little boys to get drunk. They just know that there's a lot of activity. It's a highly sellable product that the youth love. And when you control the youth, you control the future. And he is now, you can't argue with the numbers that Coinbase has done. You can't argue with, we've said this on the show a million times, that they are the largest US based financial institution from a user perspective. When you have to adapt for the next 20 years, you have to capture the youth of today. And the youth of today has put their Gandalf pole in the ground and said, we believe in these things. And some of those things that they believe in are very easily achievable by the means of Larry Fink, just by an injection of capital. The infrastructure's already there. The partnerships are already there. The users are already there. Now the regulations are already there. All they have to do is inject capital into these markets, and they become the most exciting, most used, most vibrant markets that exist on the face of the earth. And that's what Larry Fink wants, is he wants to control the most vibrant markets on the face of the earth. And you cannot deny the demand that comes along with the market. You cannot deny the activity that Robinhood gets breathed in the same sentence as Coinbase, as if they're peers from a user perspective. Why? Because Robinhood has a bunch of 20-year-olds trading equities, and they're the first ones that cracked that code. And they did it through user interface. They did it through all of these, gimmicks and, no fees. They appealed to a market, and they were very successful in getting market share against that market. And now Larry Fink's in the game, and now all of the other banks. But, I'm going to say some things that I took notice of over the last 2 weeks that I think are inevitables now. But it's very early to see this. Death of the IPO happened this week. I don't think I think IPOs are a thing of the past. I don't think they will be looked at the same way ever again. And I think there will be a declining curve of IPOs being used as a vehicle for capital raises, as a representation of ownership or, whatever. I don't think they're going to be used going forward. And then I also think the death of the banks is here. I think the banks are so far behind the curve. You look at Coinbase right now, you can earn 4.25% holding USDC. You can lend out your Bitcoin. You can borrow against your Bitcoin. You can push button, be your own bank, and play arbitrage between borrowing and lending on your phone at a ball game. You can also have deposits there that they're rewarding with, incentivized interest rates above the 4.25% for holding Bitcoin and some other, Ethereum now. They're now integrating DeFi with push button. They've done all the work. You don't even have to understand what DeFi is, and you can participate now. These integrations and the fact that they're guaranteeing deposits up to 250,000, why even say that unless you were trying to compete with banks? Why offer an ICO unless you were trying to take over business from JP Morgan and from Goldman Sachs? They are making bold chess moves on the chessboard, and my take is they've got checkmate. It's queen is gone and king is in duress. I mean, these are monumental boundary breakers that we've not seen in our lifetime before, honestly. I mean, think about...
Except here's the problem. We have, and it tells you that you're only half right. And I'm happy to talk about the history because I lived it. So in the 90s, we saw exactly the same thing happen. It was two different firms, Charles Schwab, which then led to what was at the time Ameritrade and a whole pile of other online brokers, at the same time as Knight Capital created the Knights of the Round Table, and they were a nothing OTC market maker that really didn't do very much. By the end of the 90s, Knight Capital had gone from zero to a dominant market share, along with a few other market makers that embraced the same model. Herzog, NDB, there were a few national discount brokers that basically took away what was dominant market share from all the banks, to where the banks were also ran in that space. At the same time, the Morgan Stanleys and Merrill Lynch were under enormous pressure because they were the former dominants in retail trading. The new ones came in. So what ended up happening? Well, Morgan Stanley ended up buying Dean Witter and buying other assets to create a behemoth. Charles Schwab bought up Ameritrade and a bunch of others to create a behemoth. So we had some new entrants, and we had Merrill Lynch buying and building their own, their own platforms, etc. Fast forward to today, yes, the new entrants have become a major player. I'm not saying Coinbase won't be a major player, but don't expect the banks to not adapt. They will adapt, and they will.
But don't you think the barrier to entry is a lot higher with a complete technological overhaul than a few acquisitions and some money pushing?
You're talking to someone who built technology. Look, I built the first program trading system on Wall Street. I built technology, and I oversaw. Ian built the technology at CoinRoutes, and we have literally the dominant technology for trading derivatives and crypto. Yeah, it takes time, but people are going to buy it, or they're going to build it, and they're going to get there. I mean, the edge in Coinbase, you are right about the edge, client acquisition. So that's why things like EDX as a market backed by Citadel and whatnot hasn't done anything. They don't have the clients. That's why Gemini, the twins were in there first. They sucked at client acquisition compared to Coinbase, which is why they started in the same position. And one is, I don't know, I haven't looked at the market caps, but I got to imagine it's an order of magnitude smaller, right, than it was. And client acquisition is a big deal. The technology, it's really, I mean, it's buildable, it's buyable, whatever. But the fact is, it's not, tech is rarely the critical determining factor. It's generally the product market fit and the client.
Well, I'm not just saying the tech. I guess I think it's more difficult. I just think that there's so much that they've learned. The body of knowledge inside Coinbase on how not to lose everyone's crypto is so, I don't know. I just think that there's a huge gap in my opinion.
I will make you a bet. Look, there's zero probability I go back and work for a bank. I shouldn't say that. I guess there's one probability. They make a big offer for CoinRoutes and ask me to re-step in. But outside of that, I'm not doing it. But there are people like me who can help them get it done. And here's the dirty little secret about BlackRock. So the week before Larry Fink made his famous declaration about Bitcoin and made his stance, CoinRoutes was meeting with BlackRock crypto folks who were brilliant, totally understood the market, understood it as well as we all do, maybe better, probably better than me. And that's saying something. And they had been hammering at senior management for years to try to orange pill them, to try to get them to see the light. And they were close to success. And they kind of said, we can't tell you what's happening, but a lot of stuff's going on, right? And what ended up happening, the reason Larry Fink is as zealous as he is there's nothing more zealous than a convert. I don't care if it's a religion or if it's a technology. The people who are on one side and get converted to the other side are always the most zealous adherents of it. So he was convinced over years of very smart people who worked for him that tokenization made sense. He was convinced over years that Bitcoin has provable scarcity and all the characteristics of a monetary asset. And that's why he's so zealous. And so that same thing is happening inside every major firm. Some have gone there, some have not. Understand that doesn't change the fact that a JP Morgan is going to fight against crypto at the same time as having another team trying to adopt it. Why? Because their margins when they adopt it will be lower, but it won't go to zero. So they do both simultaneously. And from the
difference is that JP Morgan's wealth management and asset management space is it's a tick on an elephant's rear end compared to BlackRock. Put it that way.
Right, but their trading space, their derivative space, their financing space, which is all going to be disrupted by DeFi. I mean, securities lending is a great example. It's a multi-billion-dollar business where the securities lending cartel of the prime brokerage make 90+% of the profit by as opposed to the asset owners. And which of course that's crazy. I mean, normally intermediaries would get 10 or 15% of the profit.
I don't understand that. I think the viewers don't either. Explain that to us.
Sure, you own equities and you own equities, and you allow it to be lent out. You will get a fraction of the revenues that are earned by the agent lender that is lending it out on your behalf.
Yeah.
Whereas normally the agent lender would take a tiny percentage.
They're not rev sharing with you.
The reason that they can do that is because there is a cartel of the top prime brokers that control the pricing.
Collusion.
It's all guys who last names ending in a vowel, because it was all done. Not joking. I know a lot of them. You know, it's been controlled by the same group of people who started in the back offices of Wall Street, and it became a huge profit center on Wall Street, and they maintained control of it over the years. There was attempts in the early 2000s.
But what I hear you saying is you're supporting my thesis that Coinbase doing this is exceptionally disruptive.
Oh, absolutely. But I'm disputing your thesis that they will own it and the banks won't go along. I'm telling you that.
Well, no, I'm not saying that they won't go along. I'm just saying that they have a unique opportunity where they have a very big moat, in my opinion, 2-3 years before anybody could catch them. You know what I mean?
Think once clarity passes, the moat's going to evaporate, but they're going to be they're still going to have a first mover advantage. I think Coinbase is destined to be like Virtu is with trading. So Virtu and Citadel in trading together are like over 40% of all the volume. The banks controlled all of that. So do I think Coinbase can have a dominant position? Coinbase, Robinhood, Ripple Labs, if they pull it together with all the things they're building, could these guys be the new wave? Yes, absolutely. I think all three of those firms, if they get all the components together, can make a lot of money.
Well, Tether probably you would include in that as well, wouldn't you? Or
depends what Bo Hines is building at Tether, and I can't talk very much about that because I have some knowledge. But the point is there are firms that are going to build crypto-oriented financial service companies that are integrated that will compete with the banks. But the point that I'm trying to make, and here's where it gets interesting, is from a listener perspective. What do they care about? The banks are ultimately going to try to fight on the regulatory side to get advantage, but on the asset side, they're in. And shorting a market where the banks are already in is exceedingly dangerous. That's the point that I'm trying to make. So your point is true. But it's going to be a broader
There's
market.
going to be a bigger battle than I'm acknowledging is what you're saying.
No, I don't even care about the battle. I'm just saying that the market cap of all of crypto, particularly Bitcoin, is going to be significantly higher when all this comes to pass.
Yeah,
that's really.
I would agree. Yeah, because everybody participating just brings more liquidity into the party. We want everybody to participate. Right. I just think that Coinbase is. I just you got to give credit where credit's due, and in my opinion, they put a big thumb in some pretty big eyeballs this last couple of weeks, and I applaud that. I think that's got Brian Armstrong deserves a round of applause and a standing ovation because they truly are owning first mover advantage in an aggressive manner to get things done that impact retail more than anyone. Like the fact that they distributed this new, ICO, Monad, or however you pronounce it, Monad, the way they did it was so fair and balanced compared to the traditional way IPOs are launched. And the fact that everyone got to participate, if you paid $29 a month to be a Coinbase One user, like these things are meaningful changes in markets and the boundaries by which, people get access to these opportunities. And, time will tell whether Monad was a good one to invest in, but it sure gives me a lot of comfort knowing that Coinbase has done some level of due diligence in order to sponsor that. I mean, they're not just out there willy-nilly and letting anybody, launch an ICO on their platform.
Well, again, the likes of JP Morgan, the likes of BlackRock, they don't stand shoulder to shoulder with Coinbase unless they're forced to. And this is that forced to moment. And what do I mean by that? Well, what I mean by that is that, again, JP Morgan has, let's call it, 67, 68 million global customers that have accounts at JP Morgan. Coinbase has 120 million plus. And so they've done the math. They've had meaningfully smart people take a look at, okay, well, what's a 42-year-old guy who, has kind of leaned into crypto? Where is his money at? Is more of his money here at JP Morgan, or does it continue to creep over to Coinbase? Like, what's that curve look like? And they don't love what that curve looks like. It bothers them. So they do. They say, okay, well, let's do a wallet thing with Coinbase. Let's make sure we're in the base layer of, just Bitcoin ETFs as an authorized participant. so that we're making money in the movement of Bitcoin, because Coinbase is the custodian of choice across 8 of the 11 of these. Let's just kind of be Coinbase adjacent, because there's too much movement going in a direction that we don't like. And so you don't get to this moment where, again, JP Morgan is making announcements with Coinbase associated with product or usability. And then also, you don't get to this moment at DealBook with Larry Fink and Brian Armstrong on stage talking about, hey, I underestimated crypto, which is another thing Larry said this morning. And Andrew Ross Sokin sitting there. We have, you want to talk about crossing the Rubicon? We have completely crossed the Rubicon in every way. So now it's about, how do you play what's next? And, a lot of different thoughts on that. But we're not going anywhere, is the point. And, to the commentary again from BlackRock about, well, it's 1996 and the tokenization process. Well, in 1996 up through 1999, there was all manner of internet companies that ended up just going bankrupt and, causing the dot-com bubble. But at the same time, there was also a company called Webvan, which was the precursor to DoorDash and Instacart, right? So Webvan didn't make it through the
shocker with a name like that. That's okay.
So didn't make it, right? But there was also the precursor to like Chewy.com, right? Which is now the big, where you order all your stuff for your pets and your dogs and all that stuff.
The sock puppet, pets.com.
Yeah, the sock puppet, right? The little sock puppet dog, right? So again, didn't make it, but conceptually we were there. So if you found a way to figure out, well, wait a minute, who's involved on the base layer of some of this stuff? That
would lead me to my next question for everybody, and I'll start, and mine's short. What area do you see as the alpha in terms of that biggest move, and how do you participate? Me personally, I'm intrigued. I'm fascinated right now by crypto brokerages integrating DeFi into their interface. That blows my mind. It blows my mind because DeFi used to be such a black sheep from a regulatory perspective, that central exchanges in DeFi were opposites. They were literally opposing forces. They never contaminated their universes. Now you're seeing central exchanges like Coinbase and like Uphold and like all these, and they're going, you know what? Our customers want to use DeFi protocol to lend, borrow, all of the, banking services that Dave was talking about earlier, that now you get to participate in the revenue generated in these protocols. Well, these central exchanges are now providing the bridge where the user goes borrow or lend, and then you read a little disclaimer and I agree and blah, blah, blah. And then boom, you're participating in DeFi. To me, that is such a disruptive force in revenue sharing behind the banking scene with the public that it's going to be hard to put back in the box, in my opinion.
Yeah, I agree. Look, I think that the important thing to understand here is it's not obvious where the linkage is from value being created, utility being generated, and token economics. And so one of the things, when Chris is drawing charts on and going through with Scott about why things are doing certain things, right now it's all supply and demand. Right now, price is everything, because there is no certainty in any of these things. So today, Chainlink is up a bunch, right? It's outperforming. Why? Because there's an ETF in Chainlink that I don't think a lot of people knew about, and it wasn't as anticipated. Whereas last week, while things were going kind of sideways for the market or down, all these ETFs for XRP came in, and it looked, and a neophyte would have said, sell the news. It was going on. Merely it was correlated to Bitcoin, so it was going down with Bitcoin. But the truth is that's supply demand dynamics. What really will ultimately matter, but doesn't matter in the short term. And I'm going to refresh this because Chris and I have had this conversation on the web multiple times. Prices matter in the short term. Momentum matters in the short term. We have a momentum trading market, but in the long run, the market does adjust eventually to where value is or where people perceive value. Now, a value could be a meme. Value could be a belief. It doesn't have to be directly passed through. I mean, there are stocks out there that have been meme stocks basically forever, that nothing has happened except for people's belief. It can go on for a very long period of time. But when fundamental things change, then you get real massive changes. So for example, when BNB, it became obvious to the market that BNB was getting not just burning from people using Binance, and that Binance wasn't going under after the settlement, and BNB chain became so big. Even though BNB can't be traded by people in the US, the fact is the chain it was a massive outperformer. And it made sense that it was. And you could and Chris is going to say, well, but the chart showed you that it was going to be. And that very well might be true. But the fact is they lined up. When they line up is when it's exceptionally powerful.
Well, don't you think ETH is kind of the leader in proving that? I mean, I hold ETH right now, even though I'm not an ETH believer, because there are certain protocols, certain exchanges, you have to have ETH to move money around. And when you receive certain, when you receive anything that's built on ETH, you have to have gas money. So ETH, is already kind of proven to have some utility from a gas token on the back of these apps and dApps that have been built.
I mean, the demand for gas for both ETH and XRP would justify a market cap about a third or a fourth or a fifth.
I would agree with that. I'm just saying it's there.
It's really small.
Yeah.
And so there was an old expression, and I learned this too. Chris, I don't know if you probably were trading. You might remember. The surest sign that an internet company was going to cease its relentless growth higher was the first quarter they reported actual revenues.
Yeah.
And I wish to God it wasn't a joke. I'm dead serious. Dead serious. Every time an internet company went from story to revenue, the stock dropped. Why?
Andrew's only back for the movie quote he's about to deliver.
Yeah, that's my favorite part right here. My favorite part. He's like, no revenue.
No revenue. No revenue.
That's Bezos' trick. He doesn't do revenue.
I mean, because look, when you're trading on 1,000, when you're looking and you see NA or not available on PE or price to sales or price to revenue, people are like, okay, I'm buying a startup. 1,000 price to revenue, people go, oh my God, what's going on? I mean, it was like clockwork in the late 90s, but even before, and it certainly as the internet bubble popped. But people forget the internet bubble popped in March of 2000. It then fell and then had a re-rally into the summer. It was a little bit narrow of a rally. A lot of the shitty companies started. They died in March and they started going downhill, right? Yeah. They never recovered, but the big companies did recover. And so you had this sort of K-shaped recovery that was interesting. I think that a lot of people are saying, you know what? We're seeing a lot of that in crypto. A lot of the crap is getting flushed and may never come back.
Yeah.
But a lot of the real stuff is going to do more than recover. And so we'll see. I don't know if that's true, but I do think that it's important to understand. Now, Jeff Dorman and other people at Arca will tell you that there are quite a few protocols that are undervalued by even traditional metrics if you actually extend them to what's going on in the crypto sphere and in terms of potential.
This is the value of this podcast. So Dave will mention Jeff Dorman and I'll mention Russ Hanneman, right? So Russ Hanneman versus Jeff Dorman. I mean, there's clearly between the two, the brain power there is extraordinary, right?
Yeah, I mean, it's not that I agree with everybody. I'm just saying there are lots of perspectives that matter on the fundamental side. And then when you talk about the price action is I would go so far as to say that we've seen more, not necessarily in the absolute levels, but in terms of movements, we've seen some very rational, intuitive price action. And in terms of things that are actually happening, like it is rational and intuitive that Bitcoin corrected from the all-time high at the same time as we had a big liquidity drawdown in the United States with the government being shut, money not being spent, We see stresses all throughout various parts of the financial system. People talk about SOFR rates. You could go through lots of different things. At the same time, the underlying economy is doing well. People are still writing checks for, build out of AI infrastructure. And by the way, the build out of AI infrastructure is the exact opposite of a bubble. A bubble is when you build shit that no one's going to need. So in 2000, people were building internet capability and bandwidth when we were using only 5% of the bandwidth that already existed. Well, that's kind of things are going to go bad. Right now, we are dramatically less than the available demand today for compute and power is way higher than we have today. So it is not the same thing. And all these people who keep saying it's the same thing, I mean, there's all these KOLs who say this shit, and they're just dumb. I mean, it's
they're
totally
just repeating,
wrong.
What they heard somewhere else. The way I keep looking at it when I look at this whole bubble talk is look at Cisco at the height of the .com bubble, right? Look at what it was doing. What was like, I don't even remember, it was like 200x or something. And then you look at NVIDIA now. And I think that's really the honest comparison. And, NVIDIA is nowhere near that. And if you're talking about bubble today and you're saying, oh, it's going to be, bigger than the .com bubble and all this stuff. And I'm like, well, okay, maybe at some point in the future, but that point isn't today.
Well, they haven't used the AI I've used. Because if you use the AI I've used, Google's dead already. If you use the AI that I use, you know that it can add orders of magnitude of efficiency to your organization across every employee. If you use the AI I use, you can see the fact that you need to measure the investment dollars we're making as a human race into AI as the most impactful dollar that could be placed right now. Because you have to ask yourself, what's the resources of the world worth? What's the loss of resources that we are literally just evaporating into the atmosphere? What's the efficiency delta that AI can bring to the world? And what's that worth? Because there's two ways to price something. You can price it as a commodity, like a cost plus. It cost me $8 a pound to produce this, and it cost me labor costs, blah, 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 and I need to make 15% margin. Or a market minus. And the market minus way you price something is by going, how valuable is my technology to the end user? AI has an infinite ceiling of value attached to the human race because it has a huge delta of change attached to it now, and it only grows at an exponential rate. You're attaching the efficiency curve to Moore's law. You're attaching the efficiency.
But the bigger point is here, and what I was trying to get at, Tillman, I agree with everything you just said. So this is not a dispute, okay? But the difference is when Cisco was trading at a 200 times price to sales, and NVIDIA is trading at 20 some odd times twice to sales. Other than the fact that it's an order of magnitude difference, Cisco was selling into a market that was already saturated. NVIDIA is selling into a market that is Velociraptor style hungry. Right?
Couldn't agree more.
It's a big difference. That doesn't mean that NVIDIA has huge growth potential. Maybe it's fairly priced, but to claim that it's a bubble and use the other comparison, that's just nuts.
I agree.
And the other thing is that understanding that the electricity grid, there's stories that are coming out that AI places are going to use local data centers using local diesel engines because they can't rely on the power grids. Well, obviously, that's not as efficient as improving the power grid. Well, what's the single commodity that is most necessary for stabilizing and improving power grids? That will be Bitcoin. And that in Texas, to not understand that Bitcoin mining isn't going to continue to grow, therefore underpinning the network, is another huge miss. And, there's a lot of that. And all I can say is it makes me very bullish in the long term. In the short term, I look at when I hate to phrase it this way, but I love the fact that virtually even the most bullish bulls are saying, well, I could see it dropping to 70,000 in the short run. I don't see anybody basically Gandalfing. I'm one of the only ones who are Gandalfing here.
Well, Dave, I'm gonna toot Chris's horn here and yours. I think your price over hash rate is brilliant in terms of an indicator to look at, and it does echo something that Chris has talked about in previous episodes, which is, and Elon Musk now agrees with. He came out and agreed with Chris's thesis, which is money. There's a singularity effect that's taking place, and that all money is really forms of energy. And that Bitcoin has proven that thesis with actual energy, and that all security of data going forward will be on the back of energy, because it is something that can be manipulated by governments, but it also has a natural law attached to it in terms of scarcity and difficult to produce, cost to produce, all of those things. Would you agree with that thesis? And then Chris, I know, did you see that Elon Musk kind of came out and said
Didn't
that?
see that. No.
Yeah.
But yeah, no, I think, here in Texas, man, we just, we keep talking about this show, and we've been here for, a year and a half, and everything that we've talked about this show is coming, and it's coming quicker than what we even thought it would. And, here in Texas, I feel that same effect, right? So here in Texas, we've got our own grid. We've got ERCOT out there doing its thing, pissing us all off as usual. I think it was Andrew just a minute ago brought up the point about the government bringing in the diesel generators and whatnot because of the power thing. But Texas is like 0.0, it seems like, or ground zero for all this, when it's Bitcoin mining, when it's AI data centers and whatnot. I mean, they've got, I don't even remember how many of them they're looking to build here, but now Chevron stepped up and said, hey, listen, we're building out, we're drilling this nat gas area out of the Permian Basin just to get direct energy to data centers. I mean, this is, if anybody ever said, man, energy's down, I don't know what to do about it. Well, these energy guys have found a way to kind of do this, because otherwise we're really just kind of screwed. ERCOT is already, just a couple of years ago during the winter, we had this really bad winter here in Texas, and we were literally like 30 minutes away from the entire grid going down. And if that had happened, it would have been upwards of a month plus before the grid actually got up fully running again. And I mean, and here we are now, just a few years later, data centers coming everywhere. San Antonio is a hot spot, and of course, crypto has been coming in here as well. And so,
Bitcoin mining is the largest on-demand user of power that you can inject into a grid. And so what Texas is using it's using an economic justification under the guise of mining Bitcoin, which can be justified. You're spending money on infrastructure that didn't exist to produce Bitcoin, which makes you money. But at the same time, what you're doing is you're adding capacity for the anomaly events where Texas goes below zero for 2 weeks, and you need that additional demand. And in a moment's notice, you can tell every Bitcoin miner electronically through automatic features that no human has to be engaged with, shut down everything and add all that capacity to the grid to serve the users. That is a demand management system that we haven't had, right? It's
right. And extend that to AI. So AI is funny, right? Training the AI models is continuous demand. Responding to AI requests is very
variable
demand. Whenever you have a power need that is bursty demand, what does that mean? That means you need to have a lot more power than is the steady state use. And when you do that, it is economically unviable, unless of course, during the times when the demand isn't bursting, you have another profitable way to utilize that power. And that's where Bitcoin comes in. Now, it's a bit expensive with AI because ASICs and GPUs are different. It's not the same. You need to have different racks in the same data center, but the cost of the ASIC relative to the cost of power once you amortize it out over, Bitcoin mining is sufficiently small as to make it a very rational decision to put Bitcoin miners, because effectively the power generation could be damn near free to the Bitcoin miner in order, it could be a little expensive, but I mean, it could be not that free, but a lot less than what you would do if you were basically paying for it. The AI will pay for 80% of the power, and when Bitcoin uses it, even though it gets to use it, they're paying it at a huge discount.
It crosses the aisle too. Forget the economics. Would you rather drive out to West Texas and see a bunch of flare-off gas wells that are literally burning natural gas into the atmosphere with no benefit to humanity and a lot of tax to the environment? Or would you rather harness that gas and run it through a cogen and produce power and power Bitcoin?
It's bigger than that, dude, because the places that don't flare gas, people don't realize that methane is 20 times more of a greenhouse gas than carbon dioxide. And so there are places on this planet with frozen methane that's melting, that when you start talking about global warming and climate, and I personally am very skeptical over the need to try to prevent carbon being burned, but I am not at all skeptical about the economics involved in carbon capture or Bitcoin mining to be able to flare off gas, etc., instead of letting it vent into the atmosphere. It's a big difference. But these are all things that get talked about, and generally with hysterical headlines, and people read the headlines and they don't actually read the story. But you know, it really boils down to that. But look, the point that I was trying to get at here with all of this is, it's not a bubble in the classical sense. We are literally, it's like saying that the steam engines and railroads steel manufacture was in a bubble as the Industrial Revolution was just getting started.
Yeah.
No, it was not. Didn't mean that there weren't financial panics along the way, but the Industrial Revolution was a big deal. Started in the late 1700s and continued for effectively 120, 130 years. Most people will date it to the mass production of the automobile to be when it was sort of, okay, we're through this stage. But the truth is that AI, as you so eloquently said in your exposition, it's the next Industrial Revolution. It really is that big of a deal.
Well, and listen, it's such a big deal. Let me give you, the viewers, one example of this, flipping the economic tables. Since cars have been created, they've been a depreciatory asset, right? We can all agree about that. We chalk it up to a loss after about 10 years of use, if that. Well, Elon Musk, through AI, is changing that dynamic, where his whole mission is to use AI to make an automobile a revenue source for you. A little robot that goes and taxis people around while you're at work and comes and picks you up after you're done and takes you home, and then does Uber trips at night for Uber Eats and drops food. Like, that's where his brain is going. AI is literally making the economics of owning an automobile something to where in the future you may own fleets of of Teslas as your primary income. Like, you're just a fleet of Tesla owners and you're just applying it to niche markets. Well, listen, if I live in the Aspen Valley, there are no Uber Eats at night. If there was a low cost way to implement that service to a community like this without, a human being attached to it, because labor costs up here and it would go gangbusters. Like, this is an underserved market that technology now serves down to the deepest level, right? You can order toothpaste and get it from Walmart 15 minutes later. Yes, sir, I will pay for that.
Tillman will be a constant user.
But AI is the point, it changes the economics in not just a little bit of way, it flips them.
The bubble stuff is just, again, market history is a good teacher, right? So, people thought Cisco was in a bubble in 98, 99 when it was 22x, revenue. And then it got to 200. And by the way, inflation adjusted, Cisco was the first, $2 trillion company, because back in 2000, it was worth $500 billion. And then again, there are adjustments to the market, right? So Cisco has survived, and right now it's like $265 or $270 billion company. But that's the whole point, is that innovation will continue. So you may have questions about valuation, whether it's in crypto or whether it's in the AI space. But innovation has a different set of circumstances that it's going to move by. And so we're, the whole bubble thing, we're nowhere near that bursting in any meaningful way. If the markets are any precursor from a history standpoint, we've got to get much further out. And by the way, the best hedge fund guys, the best money managers, the famous ones, they're the best at realizing, oh, cool, we're in a bubble. Well, I'm going to ride this way, way further than everybody else does. And I'm going to make 15x money on my positions because everybody else is going to listen to the whispers about bubble, bubble, bubble and get out of that position. I'm not. So yeah, it's, history, market history is a good harbinger of where we're at and where we're going. And going from 22x to 200x, that's it's nearly a 10x, right?
Well, the mood, right? Yeah. Hey, listen, Fibo wants me to get Dave's opinion. I think it's good to have Dave here for this opinion. Fibo's been talking about the yen carry trade unwind, all that kind of stuff. 30 years been going on, pulling back. And Fibo would like Dave's his thoughts on.
I think Fibo and I were on a Spaces together yesterday, and my wife came in and said, "Okay, we need time to go." So I left before it got to that. So I think that's a fair question. Look, the yen carry trade is the easiest way to think of it, and it's true in all cases. Cheap money is always used to chase risk. It doesn't matter what the risk is. The most important use of the yen carry trade is borrow in yen and pay a rate that is tied to the Japanese yield, and buy fixed income, often higher yielding fixed income products in other countries with similar credit, and lever it up. That's the biggest yen carry trade, and that still is the biggest yen carry trade. Now, there are some variations of the yen carry trade where people say, well, you know what? I want to buy equities on margin. I want to buy Bitcoin on margin. I want to buy whatever, houses on margin. Where's the best place to borrow money? Well, if you're a regular person, you borrow money wherever you live. But if you're a big international hedge fund, well, guess what? You could borrow money anywhere. So you could borrow money in Japanese yen, and you pay Japanese interest rates. So effectively what happens is, as Japanese interest rates rise, it becomes less attractive to to borrow money there. It makes the marginal value of buying new stuff expensive, and therefore less happens. Now, that's not catastrophic. What's catastrophic is if all of a sudden the yen started to get stronger. Yeah. When you had to repay that yen, it cost you more. People would get margin called, and it would all unwind. But so far, yen has not gotten stronger. Arguably, it's gotten weaker. So, if
you can't have deflationary economics in a debt-laden company.
You can't get deflationary in Japan. Their debt to GDP is 220%, right? It's not happening. The most deflationary thing in Japan, is their population growth rate or lack thereof.
Yeah.
Right?
So what's the real risk then? If there's really no deflationary risk there?
Well, it's not that there's no. It's that as the yen starts to, as the rates rise, it makes it less and less economic. It means that the source of new funds is going to dry up. And so if you're depending on new funding that way, or as loans roll off, the next one that you get, if you get a fixed rate loan, right? Because there's all sorts of dynamics to this. Yeah. There'll be less of it. So it's not, you haven't seen the market freak out. The reason, the yen didn't move, but you are seeing stresses in global liquidity. And that's what I was talking about. We have seen undeniably when Bitcoin went from 126 to 80, there were stresses in global liquidity. One of them was Japan announced massive stimulus and their bond yield started to go like that. And that decreases available liquidity. It's not everyone always wants the catastrophe. I want the button that's going to make things change. It doesn't work like that. That's not how markets work. I mean, Chris, I love listening to you on Scott, because when you're talking about charts, even, it's the same thing. It's a process, people. Everything's a process. The process of Japanese rates normalizing to the rest of the world and not being zero interest rate on the short end and 1% on the long end, providing an easy source of free money to buy, that's going away. But it doesn't mean that what's there is going to crash. It doesn't mean bodies are going to float to the top of the pool. It doesn't mean hedge funds are going to collapse. But if the yen appreciated, if it went from 157 to 130, oh yeah, there would be hedge funds that would be absolutely blown up. I mean, think depth charge in an aquarium, right?
The yen carry trade has also been a market boogeyman for a decade.
Well, it's because it's real. It's real. If Japan somehow figured out a way to strengthen their currency overnight, if the Japanese currency did what the Swiss currency did a few years ago, it would be an absolute unadulterated disaster.
Yeah, but why would they want? There's nobody incentivized to do that, is there?
I never said there was.
Yeah.
I'm just saying it's a boogeyman.
Yeah, but don't we? I mean, I believe in the incentives of markets driving action. Right?
Lots of people sold Bitcoin last week because they thought Michael Saylor was going to be forced to dump Bitcoin. Michael Saylor was no more likely to sell Bitcoin than I was.
Yeah.
I mean, you know, and I there was no way I was selling Bitcoin. So it was stupid. People do dumb shit, and they look at this and they see this stuff, and then they panic, and then they have to reassess because frankly, and here's the unabashed plug for what you guys do for a living. When you trade on emotion, you get crushed. When you trade in a mechanistic way, whether it's using a platform like Arch or whether it's using the disciplined approach that Chris puts in, and you guys do it differently, but it's mechanistic. Discipline, mechanistic trading makes sense, but most people don't.
Pick a system, stick with it, and don't lie to yourself when it's broken. That's literally the rules of trading, and if you
100%.
do that, you will be right eventually.
100%.
That's what we always do, is lie to ourselves, right? As human beings, that's we sit there. Anything we do,
my father used to say, Chris, you'll love this. So my father, his name was Artie, and there was lots of Artieisms. There's many that I love. One of them was the easiest. He would say, David, the easiest person to lie to is yourself. Remember that.
Absolutely.
And you know, that was one of his. He also, in terms of sports gambling, because my grandfather was a bookie, and I knew what a VIG was when I was 3 years old, was don't bet on anything that breathes. You know, he had a lot of others, right? You know, the truth is, I wish everybody understood, you know, how gambling worked and what the VIG is and how much you're paying, but most people don't. But yeah, it's easy to lie to yourself, and everybody does it. I mean, there's all sorts of really off-color jokes. I won't make them, but I will tell you that they all boil down to the same thing, which is the worst thing you could do as a trader is turn a trade into an investment.
That's a great one, because you're switching strategies.
If you're a momentum trader, you buy something because it's going up. You don't know anything about it. And I've heard you say this, Chris, many times. I don't know what this token does, but it's a great setup.
Yeah.
You would never hold on to it when the setup breaks. But
Right.
how many of the people who do buy it on the way up say, oh, okay, well, the setup broke, but you know what? I'm going to hold this as an investment. I believe in it now. I read one article.
Hey, I got to get on another call, guys. Dave, great having you on.
Yeah.
Tillman,
See you
take
guys.
care.
Sorry, guys.
No problem at all. Go ahead, man.
Anyway, so that was it. I mean, it's just that's the thing you never do. Discipline in investing. Every time there's one of these posts out there where someone says, what's the most important thing in investing? I always say discipline.
Yeah,
If
absolutely.
100%, because I don't care what you're doing. Most people don't have stupid theses. Some do it ignorantly. Like Michael Burry, what he's saying about Bitcoin, I find, and even about equities, I find it funny because, you know, it's like to hammer everything as a nail. I mean, Burry coming out and talking about the market, you know, there was an offsetting thing. So if all you did, like, you know, Mike McGlone scared me a few months ago when he pointed out that the market cap to GDP of the S&P was at an all-time high and at a crazy number. And then, you know, Robert, you know, goes by Infra on X, pointed out that that's true, except corporate profits are at an equally all-time high.
Yeah.
And so it's like, if you look only at one thing, you come to a very different conclusion. Everything has to be put in context. Whereas the global financial crisis, by the way, I agreed with him then. I was just forced to close my shorts because of what was going on at Citigroup at the time. But I was short MBNA and all these other, you know, mortgage financing, you know, firms in 2006. So, but it was obvious that the loan to value was extraordinarily ridiculous, and that the all of that. What's going on now in the stock market is there's no obvious craziness. What there is an obvious unsustainability of the narrow breadth in the market.
Yeah.
Those are very different things.
Yeah, absolutely. I would agree. Real quick here, I just want to point out, saw this a little bit earlier. There's a headline here. Charles Schwab has not been, said no to crypto and all this. The CEO put out a comment. I guess he said he feels confident Bitcoin and Ethereum will be the two cryptocurrencies it can offer to market in the first half of next year. So, interesting. They come out right here at the same time. Basically, the Vanguard's coming out and saying it. And, it's just, I think that if you're in here thinking, oh my God, it's the end, I don't think you're really paying attention enough. I think you're stuck on social media with the shorter terms, sites that are what's going on there. And, Dave, earlier you mentioned the KOLs and the nonsense that they're speaking. And what we have to be honest about is most of the KOLs, a really significant portion of them with the large followings, really don't have much clue what they're talking about. They're good at marketing. They're good at saying the things that people want to hear to get them to follow them, but they're rarely correct in whatever it is they're talking about. And the one time where they are correct, they'll use that for years and years and years. And, new people will come in, they'll continue to see that they're big and whatnot. But at the end of the day, I think this is, again, where we go back to, our listeners here, our viewers, and say, hey, listen, you have to be careful who you're following out there. And one of the biggest problems when you get involved in markets, if you don't know what you're doing, is that you don't know what you're doing, because there's going to be a lot of people out there, especially with social media today, that appear to make a lot of sense.
So could I ask you a question, Chris? It was real quick on your because I was just looking at there was a funny post from Donish about the reverse BART thing, but when you look at the Bitcoin chart, it looks almost like a textbook inverse head and shoulders at this point. The only difference is that it would say the right shoulder would need to be another month or two. But at that point, it looks pretty textbook. Am I reading this wrong? Because, I don't do what you do.
Are you looking at from the,
basically from the summer,
December, the bigger picture there? Yeah. I mean, I'm not a big retail pattern trader. I think a lot of retail gets screwed on that, head and shoulders and stuff like that. But yeah, if you were to look at it, it would look like it is creating, it'd take more time to finish it out. But the right shoulder to complete an inverse head and shoulders there up at the swing high. Sure. If you're a retail pattern trader like that, then yeah, you could see that, but it would take longer for it to play out. You'd be looking for it probably to run up there to around that 106 area, get a pullback, and then kind of head out. And, you wouldn't expect that to happen within a few weeks, it would take
months.
But yeah. But I mean, where it pulled back to technical levels, if you're a line drawer, if you're a chartist, it's no surprise where it got the bounce out. The question is, does it follow through? I like what I'm seeing so far. So we'll continue to watch it, but if it does break down, we'll look at that 74 and potentially 69K level. But right now, I mean, if you're in there, if you're trading, you're not trading that big, oh my God, the top was up there. If you are, you have to then understand that you need to use the longer time frame. And so what happens with that, that's where people get caught on reversals, right? They're like, okay, it's got to go down to 74, 69, whatever. So they're going to hold their short, or they're not going to get long as it continues to move up. But the problem is you have to look at that larger time frame. And so by the time you technically figure out, okay, maybe that low was in at 80,000, price is 106, 110, 115, somewhere around there, and you've missed a significant portion of the move. Now, what I mean is, when you're looking at the exponential increase of what you would have had you gotten in around 80 or 85 versus getting in at 116 as it goes forward, that exponential loss, makes itself more known. But, it's what it is as far as trading goes. I made this point yesterday on the Trading Tuesday show, that the real problem that a lot of retail traders have coming into social media, I started trading 1995. I can't imagine starting today with social media being like it is, because you have to be humble. You have to be honest. You have to come in and go, listen, I don't know what the hell I'm doing. I need to figure it out. And so a lot of people are coming in today. They don't know what they're doing. Big accounts are making a lot of noise. They think because they got a lot of followers that they know what they're talking about. Maybe they get something right at some point and they get hooked on that. But you just really kind of set yourself up because that information comes out from myself or others. And you honestly don't know realistically what to do with it. If you take it as, listen, just enter here and that's it. Here's your target. You're missing all the nuance that we're not going to remember to explain, or the changes in the structure as it develops that might require an adjustment to the plan that you're on. And, and that's the reality of it, unfortunately. And, I don't think a lot of people that are coming in, whether they're trading or investing, are ready to accept that and understand that so that they can position themselves for long-term success in the markets.
Yeah, I think that's right. I think we've gone on, but it's I just find it amusing, and I like the platform, and I appreciate the fact that I'm looking at 1,400 people looking at my live stream of this, so that's pretty cool. But I come back to a simple thing. Everything, because I love following you and I love listening to you, because everything you say always has the what ifs planned out and the discipline and the strategy. When you use a platform like the Arch guys have, you are basically setting your volatility levels. You're setting where you think it should be buying and selling, and it does so. And you have it happens in a way that takes the human emotion out of it. And all I got to tell people is, have your thesis, stick to your thesis. I don't care if you're a trade once a year, trade once a month, trade once a day. That's what's most important. And we get so many of these people who say things like, I don't want to pick on her, but there's one KOL who just, even if she's right, often says just the dumbest, most factually incorrect things. And it drives me to distraction when I see this. And I see there's another guy, KOL, who says literally backwards stuff. I mean, things like, well, this bull run had a 7x run. Measuring the bull run from the fall of FTX is insane. Measure it from, if you want, from the median level, which was 30 or 40,000, and we got a 3x over a period of 5 years, which in Bitcoin terms is not very much. And when you look at the amount of dollars in circulation, or you price it in gold, there's been no bull run. And so you just need to just take a step back and say, okay, what is it we're talking about? If you just did a simple math and said, what's the network done since FTX collapsed versus what is the price of Bitcoin done, you would see it. The numbers are dramatic. I mean, the network has grown significantly more than the price has. That doesn't mean the network's right per se, but I'd rather bet on that, than bet on short-term price. So it's extremely interesting. And you just have to look at it that way. And like, I'm having a conversation on Twitter saying, well, it was inflation that took out Bitcoin. Well, no, it was the response to inflation that took down everything in 21. And there's a different Federal Reserve that's about to be in power, who believes, and I think correctly, that interest rates impact on inflation is nowhere near what people think it is. It's not, what caused the great inflation of the financial crisis was two things simultaneously. It was crushing supply chains at the same time as putting money directly in the hands of individuals, right? I don't think they're doing that again. And if they do, then you're going to get the same result, right?
Yeah, exactly.
Raising interest rates was something they did because it crushes aggregate demand, except for the fact that in 20 of the last 25 years, we've had very low inflation and negative real interest rates.
Yeah.
So
the biggest things that, that most people aren't talking about, most people don't know to talk about. Most people don't understand what liquidity really is or where it is. They may assume that there's no liquidity, but liquidity is just hiding elsewhere. It's hiding in the TGA account that built up, through the summer, other things like that, and so there's just so many parts to the market that people don't understand. And they really have to, they got to be careful. If you're going to come out, guys, and be a part of the market, you absolutely have to start learning. You can't just ride on somebody's coattails and hope they're going to be right. Because again, even when they say something, you won't understand really what to do with all that information.
Exactly right. Yeah. Anyway, thank you for having me on.
Hey, man, loved having you here, Dave. Thank you so much. You were our first guest, man. We've been doing this for over a year and a half, and you're the first guest we brought on here.
I've watched a few of them. I mean, it's like whatever, but I'm going to go eat lunch now. So take care.
All right, man. Thanks a lot. Take care.
Bye-bye.
As always, guys, thank you so much for joining in. Remember, the only thing you control is how much you lose. Tillman knows that. He gives me a hard time, but he knows it. I hope you guys have a great day. Trade safe, folks. And, as far as Bitcoin goes, get in there and learn about it. Learn about it, all right? And markets in general as well. Y'all take care, and we'll see you next week.
Trading tip: always manage risk before chasing gains.